make sure to tune into Ivan's coaching calls. He did one this morning. He's putting out content for the team where he's actually answering people's individual questions and helping them out. So if that's something that you're looking for, if you're out there and you feel like social media is just too broad and you want to narrow your scope and actually work with somebody who's got some experience, Ivan does offer that within our Discord. To help you find more information about that, Chandler has just dropped the link to Ivan's channel. Click this link here. You can find Ivan on YouTube. He has his own YouTube channel. You can speak with him there, all sorts of good stuff. Ivan, thank you very much for coming on the show, man.
Thank you very much for having me.
Okay, we'll see you next time, Ivan. And now, guys, we're going to go ahead and pivot. We've got our 10 o'clock show starting now with Chris, and Frank is going to join on the show as well. Real quick, we're going to take a quick break so we can set everything up for the next show. Don't go anywhere. We'll be back in 10 seconds or 30 seconds or whatever, coming in right after this. Real quick, I wanted to throw a shout out to our stream sponsor here on the A1 Trading Show, Forex VPS. If you haven't heard of Forex VPS before, they are a dedicated hosting platform where traders, especially algorithmic traders, can set up an in-the-cloud computer to run their MT4 24/7. If you have any experience trading with robots on MetaTrader 4 using expert advisors, they have to remain up all the time, and keeping your computer on is not always practical if you have like a power outage or that sort of thing. And with Forex VPS, you can set up a dedicated hosted computer in the cloud to host your MT4 or 5 platform. They have the fastest execution in the industry with latency less than 1 millisecond, which means when you place trades or your system places trades, it's near instant. So I've got my VPS open here from Forex VPS, and you can see, I just want to show how quick the latency is here. So if I click sell, you can see it is right away. I'm in the trade, all set, as if I was sitting on this computer, even though it's somewhere in the cloud. And if you're an algo trader looking to get set up with a VPS, we've got an awesome discount for stream viewers. We can get you 30% off with code A1Trading30. The link for that will be dropped in the chat right now. If you're watching this stream at a later time, you can also find it linked in the description below. They have a 14-day money-back guarantee, so take advantage, check it out for yourself, and now back to the stream. All right, thanks to Forex VPS for helping to make this possible. Speaking of making this possible, the real show starts now. We got Chris and Frank in the room. How's it going, guys?
Hey guys, how's it going?
What's happening?
Not a
Happy
lot.
Monday.
And you know, we've got several places we could start here today, and I'm gonna let you guys kind of pick up the show for a little bit after this. But I wanted to jump in and just ask a couple quick questions. Chris, thoughts on commodities? Same question coming to you, Frank. Gold is jumping right now. I mentioned this just before you guys joined, that if the market were to close in the COMEX right now, we would be sitting at an all-time closing high for the gold market, far off from silver. But same thing with well, Bitcoin's not quite there, but it's close. Bitcoin and gold. We'll go to Chris first. What do you think about all this movement that we're seeing?
I think this is really the technicals at play. The saying is there's no such thing as a triple top, and so we have resistance, we have resistance, we have resistance, and if this was forming some type of wedge, like so, I don't think this is a rising wedge. I think this is a wedge that possibly blows off the top. So when I looked at this last night, I mean, we had a huge move on Friday. I looked at this last night and I'm thinking, okay, if we close above these levels, and my level is this, 2075. We close above 2075 with a weekly candle, and all week we just sit there with day after day after day above 2075, then I will start looking. And obviously I hate buying high, but I think that this breakout is the real deal. We'll come up, if we test this level, that little low volume, spike we had during the holidays, we're in some fresh territory, breaking this resistance level. I mean, considering the dollar index has been so quiet, clearly things are moving on the peripheral, right? Like the dollar, if it's going to get weaker, it makes sense. Gold's going higher. Like oil and gold are making these moves ahead of real traction on the dollar index. But I cannot deny that resistance to me is 2075, 2100. The good thing is there's lots of upside. I mean, so we might be talking about this, oh, it sucks to buy high. But even if you looked at the trade from this standpoint, if I bought it here with a stop loss below that low, that's my measured move.
Yeah.
So it's not like we don't have good reward to risk. And so it's just a matter of how do I get positioned? How aggressively do I want to be? I think I'm willing to take like a test trade or so to get started on the bullishness. And then from there, be a little bit more convinced, like, okay, getting paid on the test trades. Now let's start positioning in with a little bit more of the bullish outlook. So I'm
that was
bullish.
I was just going to say with gold, that was my my test trade was this one. Obviously, in hindsight, so I'm long gold right now. My test trade was back here, and obviously, in hindsight, I shoulda, coulda, woulda put on a significant size. I put a relatively small size. I bought GLD. Just bought the shares, 434 of them. So I'm up
Okay.
nicely, but this is a
Yeah.
huge move for gold. This is like a very rare to get like 3.5%. I wish I could take these sorts of trades on the regular. I do not, but when they happen, they're really nice. And you know, I want to ask Frank the same question. I have to preface this before I ask you, Frank, because I know this is like a sore subject for you, just like the Nasdaq was a sore subject for me. Because the Nasdaq, I totally got whipped out right on the day before Nvidia earnings. So I understand how a rally can feel a little bit painful. I know, I got to say, Frank was so right about gold bullishness, but you didn't quite catch the move. Are you looking for pullbacks? Or how do you approach this when you see it run up like that, Frank?
Yeah, I mean, the momentum there is very strong. I do believe it'll keep going, but I don't ever buy on moves like this because one, it can come all the way back down, and if it does pull back, that's where I'll be looking for entries. 2060s now. Um, Before I was looking at the 2040s and never got in, and so I did miss a huge run, but I think as long as this is what's going to have to play out for me too. Um, Other than a pullback, um, just some sort of relief so we can like jump back in. Fundamentally, where we are now in the economy is this NFP report is going to be very pivotal, in my opinion. And
Yeah.
what Chris was saying about the dollar index being quiet, this is the reason. It's because we're looking at stubborn inflation right now.
Yep.
Core rose. GDP came in lower than expected. It's also kind of stalling here.
PMIs.
Labor and GDP are very important in just measuring economic growth. So if we get this NFP report coming in lower than we want, we're going to see slower output, slower economic growth, and the potential of higher inflation rates. With that, that's the perfect stagflation setup we
Yeah.
got going on. So that's the fear driving gold price higher. That's the fear keeping dollar index where it's at. Now, if we get a higher NFP number on Friday, there's I guess a bullish case for the dollar, because then we can hold on to some hope with, hopefully, we don't run into the stagflation issue. But I think if we start seeing lower NFP, we start seeing lower output, if inflation rates don't move lower or if they tick slightly higher in the coming months, that's putting the Fed in a tough spot.
Yep.
And that is definitely a stagflation problem. So gold will take off. Oil pretty correlated with the dollar. So I'm in an oil trade still, but I'm not up too much. That's been relatively quiet. Gold's the winner here, and cryptos too. That's for other reasons, but
We definitely got to talk Bitcoin in just a minute. I want to ask, kind of bring that full circle. You made a really good point there. I want to ask Chris about is so stagflation, this idea that you could have slowing growth, which we got evidence of, as you mentioned, in the GDP number, the preliminary GDP number, as well as the PMI numbers for manufacturing, both kind of disappointed last week. At the same time, all of our inflation reads that we got were hotter than expected. So if you're getting this scenario where inflation's kind of hot and at the same time growth is kind of slowing, my question to Chris, as I know we've been discussing this for a while, is that potentially the catalyst for a pullback in the stock world as well? Because obviously stagflation is terrifying for stocks if that were to happen. Could that give us that 5% pullback or that several percent pullback that we've been talking about?
I think right now anything could give us that pullback.
Fair
I
enough.
just looked at the numbers. If you look at the weekly time frame, this is nuts.
Yeah.
We have listened to these indexes: the S&P, the Nasdaq, the Nikkei 225, and the DIA. The DIA came in 15 out of 18 weeks bullish. in the last 18 weeks, like 15 out of 18. The ones I just mentioned, the Nikkei, the NASDAQ, and the SPY, 16 out of 18 weeks bullish. A pullback has to happen. Unless we're going to a total broken chart, technicals don't work anymore, which we know that's not the case. It's like this is where I think a lot of the bears get tested, where they're either bullied out of the market or they're giving up and like it's just not worth shorting. But that's the type of pain points that I think the market is stretching to right now. And like looking at Friday's move last Friday, it's like super low volume on Friday, drifted up $4.5 higher. That 515 level, all the open interest this week I see is peppered lower, like 505, 500. And I mean, 16 of 18 weeks is insane. Usually the cycles are like 7 to 10 candles, 8 to 11 candles. Once we get into just a crazy run like we've seen since that bottom in October, I think a pullback is long overdue. Again, and it could be very violent. And I just don't know if it is non-farm payroll the catalyst. Probably not. Is CPI PPI combo next week catalyst? Maybe it's the Fed the 20th, but I think that the dust will settle in March. And so I'm actively taking some bearish stabs at the market. I do expect the timing to be usually February is that month where we have like the big expiration, December, January with the big leaps and all the open interest out there. These levels get hit with these low volumes, but you get into February, it's kind of reality. You get into like a slow growth of Earth, slow earnings season. But this was like just 1 and 2 and 3 standard deviation moves in earnings reports, which were insane. And just the pure look at the market is like, okay, everything's a little crazy. Like Bitcoin stretching the way that it is. I love it. Obviously, I think we're all celebrating higher highs and rooting on Bitcoin for 69K and maybe 100K this year. But even that, the way that jumped 25% last week, probably needs to pull back. So I'm
Chris,
looking at the markets. Yeah.
I want to just add to your point about, here's kind of our February historical seasonality. I was thinking the same thing. I thought a pullback was kind of coming. Didn't quite get it, but at least in the last 10 years, when you narrow your scope to the last 10 years rather than maybe like a 50-year scope, we actually do see that there's a potential pullback in the month of March, which is what we're obviously coming into. So, of course, that is just seasonally what has happened. It's not a guarantee, but as we mentioned in previous streams, if you had followed seasonality last year, you probably outperformed the market. It was a phenomenal indicator last year, and should be interesting to see if we can get that pullback. I'm totally with you. I think that the market will not continue at this trajectory. I made a Twitter post or an X post that we're up on the S&P 500 8% in the first couple months here. The average historical performance of the S&P 500 is 10%. It doesn't mean that we can't be up 28% by the end of the year, but you just kind of have to call into question, is this move a little bit too fast, too quickly? And maybe it's just a healthy thing for a pullback to kind of correct. Frank, I want to ask you same concept. Do you think a pullback is coming? And if so, how significant of a pullback is? I mean, if you're right, if we do continue to see that stagflation narrative coming, and that I think I want to add one more thing to what Chris said. He mentioned probably not NFP. I would actually argue that it's not any specific data point that's going to turn the market on a dime. It's going to be a sentiment narrative shift where you start seeing CNBC all of a sudden all over the place starting to say stagflation is a real threat to the market, and then boom, some sort of like change that's going to give you your 10%, not just a blip down, but a corrective move. What do you think?
I think if that narrative flips, the change or the pullback could be pretty severe. And I don't know where it would go, to be honest, but I think I'm better at finding directions than guessing price targets. So I think until then, we're going to be okay. But what I'm seeing is something pretty concerning. And if everyone starts catching on to this idea, like you said, if CNBC starts talking about stagflation and just the media's bearish and concerned that it's going to turn the markets around pretty hard. But I wouldn't be surprised if the NASDAQ and the S&P gave back all their gains for the year, if that was what happens, if they start talking about, a slower economy and higher inflation and then higher interest rates for longer and maybe even a possible rate hike. So
Yep. No, I think the risk reward here, in my opinion, looks skewed where there's just a lot of risk to trying to continue to be a bull at these levels. Whereas I think that there's just a lot of reward in either waiting, or if you're more aggressive, maybe short selling. But yeah, so kind of interesting. Those were my prompts here for the day. I'm gonna back out and give you guys a few minutes. Frank, you're welcome to stick around for a few minutes, or just chat options with Chris, whatever you guys would like to do. And Chris, I'll let you take over the stream from here. Thanks for hanging out.
All right, thanks, Nick. Frank, you
All
ready
right,
to
see
stick
ya.
around? Is your laptop full battery today?
Yeah, I brought my charger today. So I do want to stay for a bit. I have a question for you, or actually a couple questions.
Okay.
So I'm still on level 2 options, so
Okay.
I can't do credit spreads, debit spreads.
Yep.
I basically can't sell anything. So I have a straddle position, just a test position on BITO. And that is both call and put sold at the same price at 28.08.
28.08. This is what's the expiration on this, Frank?
March 8th.
So 3/8 expiration, 28. That was actually the strike price was 28.08?
Yes.
So March 8th. So you don't have a 28 or 29, isn't it? Is a whole number for BITO?
A whole number?
This is my option chain right here. I'm looking at March 8th, $28, $29. These
It
are my
was
strike.
28, but I guess I got filled at 28.08. But 28 was the
Okay, so let's get this. All right, so we're doing a 3/8 expiration, a $28, and you're in a long straddle because are your strike prices the same? You bought a call at 28
right.
and you bought a put at 28?
Yes.
Okay. So let's look and see how that price out. When did you buy this? Did you buy this morning?
No, I bought it like a week ago.
Okay, so 28 long call and a long put. Can you tell me what the total debit was on that?
It was 276 total.
Perfect. Okay. Well, 276 total. It's probably trading for more than that now. You're up $2.50 on the upside, which means your call alone with another 3-4 days of expiration. So you have some time premium left in the trade. You should be up. It's probably close to break even. I would guess maybe higher. Depends on. Yeah,
It
you
is
should be
higher.
positive.
It's higher than break even, but it's not as impressive as it looks. So my call. The call was 146. Its price now is 289.
Yep.
The put, however, was 131 and is now 33 cents. So pretty bad on the put side, but the whole point is to hope for the market to move in either direction pretty hard. So I am up currently. My total, so I got it 276. Current price now is 322 for the whole thing. So it's all right, but I'm wondering, because I'm buying, you want to do something along the lines of getting out quicker than waiting for expiration, because I've seen break even levels on here was like $30.70 or 25.25. So that's when I start breaking even at expiration. But because Bitcoin's moving so hard, it seems like maybe this is one of those handful of times where straddle could be pretty profitable. So I was wondering what you would feel about, like, what to do going forward, or how would you approach this? Would you just take the profit you have now, or would you wait for expiration hoping for higher numbers, or you get out?
I'm ready. Yeah, I'm ready. So I say right now, the way it's sitting with only a few days left to expiration, you want time to be as far out as possible. I mean, again, you did the right thing by not overpaying for the straddle. I did the math here. You're looking at roughly a 15-16% return on that position, because Friday's expiration is where this is essentially only the real value of the option. So that's the fancy word, intrinsic value. So $28. If BITO is trading at $30 on Friday, your call side's only worth $2 and your puts are pretty much worthless. So right now, because there's some time left in the trade, you could get out of here for 320. And I think that's worth taking the trade. So if we did 320 minus the 276 you paid for it, you're up 44 cents. Like I said, you're looking at about a 15-16% gain. Personally, if that was me, Frank, I would just take the profit and close out the whole trade so you can get a 320, 325 net credit, which gives you, I mean, if it was a one contract trade, you're going to make, $50 or so on it, which I think is great. So you took it in as a 276 debit, which means you can close it at like a 315 to 320 credit. Take the money. And then if you want to, I wouldn't mind talking through like a fresh position on BITO, because I was doing a lot of digging this weekend, and I like the idea of going out a little bit further, but then also selling against it. So it's essentially a diagonal spread, which is just a fancy way for saying I think BITO longer term is going to be a bullish instrument. But rather than going out, let's say 60 days or 90 days and paying for all that time, I pay for that time, but then in chunks I sell against it to lower my cost basis and collect more premium. Does that make sense?
Yeah. So you were talking about
first
this
step,
last week too.
yeah,
Um,
yeah,
I also have a question about that. When you say
okay,
selling calls against something you own to
yep.
get a lower cost basis, is that, can you also look at it as this way instead of lowering your cost basis? Is it also, or could it also just be generating income off of your shares? Because does it necessarily lower cost basis, or is it just an income generator for
Well,
owning something?
if I own shares, if I own shares, I'm lowering my cost basis, because the only way that I'm collecting income week to week as like as an option seller, but there's two ways I can realize that profit. If I'm going to realize the income, let's do this. Let's walk through a position here. So let's
Okay.
say that on BITO. So this is your trade here. It right now this is so you paid 276 debit, currently trading for a 320 to 325 credit, right? That's about a 16% gain. If you wanted to take the profit now, which, and again, I'm putting myself in that situation. If that was my trade, I just take the profit. I think you had a good trade, but the 8th is this Friday.
Yeah.
We could stretch a little bit higher, and you can always look back in hindsight, be like, oh, I should have hung on to it. But if it goes sideways or it comes back into this area, if it fills this gap right now, that little gap from Friday's close, that's around 28.92. That's going to torch any credit that you have. If it comes back and finds that close from Friday, these are essentially going to go back to worthless, and you're underwater on the entire position. So that's why I like the idea right now. You're getting a fresh high in the day. You're up about 15-16% of the position. What would have been ideal, just looking at the chart, would have been a straddle somewhere in here around that $25 handle. Now you're talking up, $5 on the call side. That's a big difference than, being up,
Yeah.
just like 50 to 60 cents. However, I still like the trade. I still like the trade, getting out of it for a small profit. And then this is what I would do to position for it, moving out a little bit further. So let's put a pin in that one and say that's what I'd say on the straddle. If you wanted to look at a different position, if you want to generate income, so to generate income, I want to own the shares of BITO, okay?
Okay.
And then add covered calls. If I do that, I do two things. One is I lower my cost basis. And two, if I close the shares, I increase my net gain. Right. And so we've talked about this in our little one-on-one sessions. I mean, if I did nothing but buy and hold, if I buy the shares of BITO at $30.53 and I hold it, I'm excited when this thing's up here towards the highs around $45. And so we go from 30 to, let's say, 45. And there's my gain right there if I just do a buy and hold. Okay. But if I buy the shares, let me make sure everyone's following the image here. So if I buy the shares, at 30.50. Okay, and then I'm going to hold and sell at, let's say $45 for keeping the numbers pretty simple.
Yeah.
So that'd be what, $14.50. $14.50. So that'd be a net gain. I'll keep it in black here, right? 1450.
It would be 1550, I think, right?
No, because 45
Oh
minus
yeah,
30 is
yeah,
15.
you're right. I
Okay.
can't do math.
Sorry, that's why there's calculators. We're in that age, right?
Yeah.
Can you just ask like ChatGPT to do the math for us? That these days that's about what everyone's gonna have to do and rely on it. All right.
Honestly.
So 45 minus 3050 is 1450 net gain. And that would be if I did nothing but buy and it goes up and I dump it at 45, there's my gain. Now, if we treat this with I buy the shares at 3050, and then let's say this week, if I buy the shares right now and I go out to the 8th, let's look and see. I'm going to keep this font up here and I'll go into my options chain. So if I went to this week, if we buy the shares at 3050, we could go out to I like this, like the 15 to 20 delta. I could sell a $34 or $35 call. And again, I'll just keep it simple. Let's say we're going to sell let's sell the 15 delta because I don't really want to get the stock called away. I just want to keep collecting some premium. So if I go ahead and sell, I'm going to sell this $35 call against the shares that I just bought. And let's say we do this for the next month. So let's say on average, we can go out week to week to week and do like a 15 delta. We sell the call against the shares. We collect about 25 cents on each one. Okay. So here's what I could do. If that's what I did for the next month, and I'll type this out as I'm doing, I'll put a different color here. For the next month, let's say that I do a covered call here and I collect 25 cents. I do a covered call here, collect 25 cents, do a covered call here, collect 25 cents. I do that for a month. Okay. So that's what I did each time. So we're saying, add a 1 week covered call and collect 25 cents credit each week. And again, this is just for an example's sake, but this is what we can do trading some options. If I did that for a month and I lowered my cost basis by $1, now my cost basis is $29.50, right? Which gives me a net gain of $15.50 over the next month that I would hold this. So if it took, let's say, a month to hit $45, if over that month I collected income and lowered my cost basis with a covered call, I'm going to grab another $1. Now that might not seem that impressive, but the difference between on a stock that's not super expensive, if I did a $14.50 gain out of a $30.50 position, that's a 47% increase on that stock, 47.5%. Now, $15.50 is 51%, right? So, I mean, just that alone in a month, you increase your profit potential, you increase your net gain. And if this is a stock that you're like, you know what, I don't really want to let it go at 45. I just want to keep using covered calls and lowering my cost basis. I mean, just let's go out 3 months. Let's say you did this on average for 3 months, and all of a sudden we go from $1 month 1, $2 month 2, $3 month 3. Now your basis from 30.50 is down to 27.50. Same
Can I ask
situation,
another
same story.
question?
Yeah, go ahead. Go ahead.
Regarding selling calls and how far you go out.
Mhm.
Do you like doing it closer to the date? Like, are you looking at March 8th right now, or are you looking out like 20 or 30 days?
I did March 8th because I was looking at I did an early one, I think. Did I do that? Yeah, March 8th. So that's actually a fair amount of premium to grab this week. And so like I said, if you did this for a month and you collected, 25 cents a month, that's on the low end. I mean, I could get 25 cents a week and go out a month and possibly lower my cost basis by an entire $1.
Yeah.
Right? So I mean, so we could lower our cost basis over that month by $1 or so, and you do that, $1, $2, $3, and it just you can see how that graph looks. It essentially is this. I mean, if you buy, I'm going to put blue for buy and hold. So if we buy and hold, there's our buy, there's our hold. We let go of the stock price, and that's our gain. And you and I've done this before in our one-on-one. So that's our gain. If we use options and incrementally we're active around those option trades, we lower our cost basis right here. You can just see that just graphically it increases our net gain because we're just selling calls and using options. And in the example, I mean, I remember this. You just asked me, is it better just to buy and hold? What's the advantage? And we showed a lot of examples where if you're using options, you're going to lower your cost basis as a net result. Now, if you have again, buying and holding, and even buying and then selling calls, or collecting income around the owned share price, you have to remember it's all about buying power too. So in your example, I mean, I'll ask you this: could you afford to buy 100 shares in your account? Or would you want to? Not that you can't afford it, but do you want to? Do you want to allocate X amount to BITO? Do you want to hold those shares and tie up, $2,000 to $3,000?
3,000 is like almost half or
Right.
half.
Right. So that's a good situation where it's like, doesn't sound like you want to own the shares. And so there's more ways to do that. Now, here's another example. You and I haven't talked about this, but I'll share this today. There's a way that you can get really fancy with options, and you can do what's called I call it just a synthetic spread, which all that means is I want to trade options like I own the shares, but I'm going to do so for a fraction of the cost. Okay. So here's one way that I could do that. If I go to the call side right now and I'm looking at these deltas, if I bought a 70 delta, which is right here, so this is a $29 call. If I bought this call for $2, okay, and I buy 2 contracts. So this is going to be a +2, which means it's going to be 2 contracts at the 70 delta. So this would cost me $400 to take that trade. Now, against that trade, I could sell a 50 delta put. Or I'm sorry, I would sell a 50 delta call, which is going to be right here. So -1.
So you're buying 2 calls and selling 1?
Yes. And so what that gives me is it gives me the control of, I essentially have 100 shares running for unlimited profit, but it offsets the cost of my trade. Okay. So there's two ways we can do this. There's 2 situations. We could do it this way, where it's kind of a synthetic play to control 100 shares, have unlimited profit potential, but also offset the cost where, 214, if we did this right here, just if I put it in, so I go, the 214 is 70 delta. So if I bought 2 of those, okay, so I'm going to go to a quantity of 2. And then if I sell the 50 delta against that, I'm sorry, this needs to be long, my bad. So I need to go long 2 and then short 1. I might have to do this separately. There we go. So I'm long 2, short 1. Okay. Now the cost on that, if I'm long 2 at $2.14, so $2.14 times 200 shares, it's going to cost me about $428. If I sell against that a 105, so for $323, I essentially take a trade that is like owning 100 shares of BITO. Now, hear me out. This only goes out to March 8th. So this trade, we probably should go out a little bit further. Let me just delete this and start. I was just trying to get it priced in. But realistically, if we wanted to take that route, we should probably go out, 50 days to 75 days, go out in the distance, give ourselves a, let's say a 3 to 4 month horizon. Where do we think that Bitcoin goes up as a, derivative, right? BITO is a representation of Bitcoin. I'd probably feel comfortable going out through, April and May. Give us a chance to see a pullback. And there's 2 ways I can play this. One is I would buy the 2 calls, sell the one against it, and just have basically 100 shares that I control running to the upside with unlimited profit. So if BITO continues to run like crazy, if Bitcoin continues to stretch above 69,000 and maybe make a real mean run to 100 grand, that call option, almost like tick for tick, is going to be trading in profit. So the nice thing is because if you're talking about deltas here, you're almost trading like 100 delta, which means for every $1 that you get in the instrument. So if BITO goes up $1, you also go up $1. And that's why this is kind of a synthetic play where you get all of that extra value, where $1 in the asset means $1 more in gain in your call. Does that make sense? I know this is out there a little bit.
It's confusing because you're saying you own 100 shares already, or
well, I'm controlling. It's like I'm controlling 100 shares. I'm trading it like I control 100 shares because
nothing is owned, and you have 2 calls and a put, and 1 call is in the money, or two of the calls are in the money, and the sold call is out of the money by like $1.
Yeah,
What
there
would-
and it's really the two calls are in the money, right? The two calls that I'm long are in the money because let's say we're going out here. Let's look at this one to May. Okay. So now you're going to see the pricing is a little bit different. If I did the 70 delta, now I'd buy the $27. So it's still a 70 delta. So I'm going to buy that. I'll buy that twice. So that's my 2 there. And then I would sell the 50 delta, which is going to be the 32. And that's just slightly out of the money by a couple of strikes, but I'm going to sell that. Okay.
Okay.
So what's nice is my max profit. I need to change the legs here because it'll hang on a second. So this is 2, and then this one needs to be changed to a -1 there. Now, this is what I want you to see, Frank. Can you see my numbers here? So it shows my max profit
Nice.
is unlimited because
Okay.
I am still long on that extra call to the upside. Okay.
Okay.
So I'm going out 74 days to say that, I understand there's max risk because what's my max risk? It's a debit trade. So this is what I'm risking on the trade. Now, for your account, $800 is a decent chunk of risk, but it's also a lot different than owning shares at $30 a piece, right? If you own 100 shares, that's a $3,000, cash position. You can do the exact same thing, have the same type of exposure for $800.
Okay. I see what you're saying now.
Okay.
That makes a lot of sense because owning a buy and a sell call are offsetting. Meanwhile, you take an additional buy call, and it yeah. So exactly what you're saying. It's representing like owning 100 shares, but on $800 versus 3,000.
Exactly. So I do this a lot in my IRA accounts that I manage. I do this a lot because this is the way that I can reduce that cash buying power. So an IRA account typically doesn't have margin. If it's a cash on cash position, if I want to own shares, it's $3,000, right? Because it's a $30 stock. So I can do this, control like I have the 100 shares, get the extra, the intrinsic value of if BITO goes up, that 70 delta that you see right here gets closer and closer to like a 90 delta, 95 delta, 100 delta. Once we're trading at 100 delta, every dollar that BITO goes up, my call value increases by $1, which is the
Okay.
same as if I own the shares. Every dollar it goes up, that's $1 that I gain on the position. Does that make sense?
Right.
And you're doing it at a fraction of the cost. So that's, like I said, kind of a synthetic way to play it. I like that a lot. The other way would be if that's still a little bit too expensive, there's cheaper ways to do it where I just clear this trade out. Still consider the same thing like a May expiration. I think a dipper pullback is coming, but I could stagger into this trade. Let's say I like it right now. I don't mind going like, in the money here. I think the 70 delta is pretty good, but I'll just do a 1 call option. So if I bought the 70 delta, it's going to cost me about $6, $6 and change. Now, here's what I could do against that. This is a diagonal spread, and that's just a fancy way of saying I'm long on BITO out to May 17th. That's this play right here. That's all I'm doing is I'm just going to buy a call
Mhm.
out to May, and I want price to go up. Now, that we talked about this. If this is all I did was buy a call, at $27, that's the strike price that I'm buying. It's going to cost me $6.20. What's my break even on that, Frank? If all I did was buy a call.
Um, say the second part again.
Yep. So if I buy a call and it costs me $6.20, what's my actual break even on that long call?
Uh,
What does
20
BITO
or
have to
30, 27 plus the what's it called?
plus the premium, plus
The
what you paid
premium
for it,
that
right? Plus the
you're
debit.
paying.
Yep.
So we'll have to go 32, 30. I don't know. Oh wait, you have it.
I got it right there.
33.2.
Yeah. So it's 27 plus the debit that I paid. So my break even on BITO is 33.20, which means for me to make money on that call option, I need the actual asset to go up to $33. Now it's trading at $30.43 right now. So it's not like it's that big of a stretch to go up $3. We've certainly seen it rally a lot. I mean, the instrument alone has gone up from 18 to 30. It's up $12. So another $2 to $3 to get us closer to break even. It's very doable, right? Now, because this is all the way out to May 17th, if I buy this position now, what I can do against this is I can sell calls against this position. All right. So here's how I would do that. And I'll just type this out. So if I buy, let's say I buy a buy to open, the 517 expiration.
Can I say one thing
Of
before we?
course. Yeah.
I don't know the math involved
Okay.
yet, but will this basically say that your break-even price will go down from 33 to 30 or something?
Yes, exactly.
Okay.
That's exactly. So what I would do is, and here's how I could do it, right? I could say that I could just do the same thing as the debit spread and do, okay, so the 27, and then against that I sell, I don't know, I can sell like I mean, there's a decent amount here. I could sell, I'm looking at the deltas here. I mean, I could go down a little bit, sell the 25, sell the 25 delta. So if I did a debit spread, I could do a $27 long call and then sell against that a 42. Now, 27 and 42 is a $15 max upside. Again, I'm just doing some simple math here. So there's another situation. So I could buy to open the $27 call, sell to open the 517 expiration $42 call. And if it did that, we're looking at, I've got it. You see, it's trading for $3.84 debit.
Yeah.
Right. So if I have that trade right here, that's my long call. That's my sell call. I'm going to pay about $3.85. Now, that's not too bad. That brings my cost basis down to, we got to do the exact math here. And sorry if this is boring anybody out there, but it's just how we figured out. So $3.84 plus my $27 strike position. So my break even is $30.84 instead of $33 and change. So
Right.
I lowered my cost basis quite a bit. And now if the stock gets called away, if BITO is up above $42 and it gets called away, minus $42 where it gets called away, so $3.84 plus the 27, 30.84 minus the 42. I get called away for 11.16 out of a 30.84 cost basis. Is that right? Yeah, so I'd make 36% return on that position. That's pretty good, right? For something I'd hold for 90 days. You make, if it's one contract, you're gonna make $1,000 in the next 75 days of trading. Now, here's what I want to do. Let's take this one step further.
Okay.
That's just a debit spread. That's all that is. So if I did the same expiration, I buy the 27, I sell the 42, that's just a debit spread. Okay. Max profit on that is if price is past $42, I cap myself there at the $15 upside because that's the difference between my two strikes. Now, what I could do to do this a little bit differently is I think, and I believe this, I don't necessarily have to get all that premium up front out to May. What I could do instead is go incrementally. Maybe I could do, again, I could go week to week because this is a stock that does have some high premiums right now. So you could sell against that with the higher implied volatility. I could probably go get 25 cents a week on that. So if we go out 70 some days, that's roughly, 2 full months away. Let's just say that I collected $1. Let's say I collected it again. It's going to be the same type of thing. I could collect $1.
What if they're not the same date though? What if you did like 518, or say you did April something, and then you sold a call for a September expiration? Or you did like say a May buy call, and then you did 1 week out sell call. So sometime in March.
Right. That's what I was going to say. So you're right. What you want to do is if you're going to sell something, you want the expiration of the sell side to be earlier. So if I went out to May on this right here, so May 17th would be the $27 long call. So change that to a buy trade. And then what I would do is I take this trade, and then instead of doing the May sell at 42, I'm going to go out less. And so like March 15th is a monthly, right? So I'll go out to March 15th, which is only 2 weeks out, and I could sell this. So implied move, this is about a, IV ranking is 99%. We got about a 350 expected move on this stock. I could sell, and again, there's two ways to look at this. If I sold a 25 delta, I'm going to collect some decent premium for it. If I do a 20 delta or a 15 delta, the odds of the 20 and 15 delta getting called away is slim. So that's a good thing, because the question for you, Frank, is do you actually want to lose the stock as soon as you get into it? Like if you took the $27 long call, do you want to lose the stock on the 15th for like a, a $7 or $8 gain? Or you want to give yourself more time and try to lower the cost basis until you get closer to that expiration?
The latter.
The latter. So if I sold, I like this. I'd sell like the $36 or $37. That's a 20 delta and a 17 delta. I could sell this 20 delta $36 call, and I could sell that for 50 cents. Now, again, that's going out 2 weeks. So 50 cents 2 weeks, it's the same as 25 cents in 1 week. It's getting $1 a month, right? So all of March, all of April, and into that expiration into May, we can probably collect closer to $2.50. Yes or no?
So
Roughly.
on sequential trades, or you just
No, I would just keep selling. I just keep selling. So I would do this. I would buy to open the 5/17 expiration $27 call. Okay. And then I would sell to open the March 15th expiration, and we did like a 20 delta, and that was a $36 call. Okay. And if we did out 2 weeks, we're roughly getting 50 cents, every 2 weeks. Right. So
Okay.
once that expires, so this is what we want. Ideally, we want to take this trade, and this is, if I go down here, this is a diagonal spread, because we're buying the longer call out in the distance, and then we're selling against that to chip away at the cost.
Okay. Right? So March 15th, that's like 1 week, right?
Right.
That's a
So
little
this
over
week
a
is
week
the
away.
8th. The 15th is 2 weeks out.
So the 50 cents is what you're saying we'll collect at the end once we hit 15th. And
Yes.
then, so once that expires, we collect the premium. Price is still underneath 36. Say it's like 33. Would you go out another 2 weeks and do like, I don't know, like a April 1st or something?
Yes. See what I'm
Okay.
typing? You want to repeat this. So I go out and collect my 50 cents. And the idea is I don't want the stock to get called away at $36. I want to keep, so I buy the $27 long call. I want to keep adding covered calls to it. I want to keep adding sell calls against it to chip away at it. So if I repeat it, and we go out 2, 4, 6, 8, right? We just keep adding, not consequentially, because I don't want any naked options here, but I would just sell a call against the long call. And so if we repeat this 2 weeks, 4 weeks, 6 weeks, 8 weeks, that gets us out to, 8 weeks is going to get us into April and change. So we roughly have about 10 weeks, right? We have about 10 weeks to the long call expiration. Okay. So every 50 cents we can collect for 2 weeks, that's going to give us roughly, what is that? So $2.50. So we're looking at approximately $2.50 of credit we collect on sell calls against the long call position. You with me, Frank?
Gotcha.
Okay. So if I take the trade, so it's right now, all I have is the, if I take away, it's going to be like $5 to just buy it as is. So check this out. It's $5 if I just buy the long call as is. If I get this credit like I'm doing right now, I'm going to collect about $2.50, which from a $5 long, what does this lower my cost basis?
250.
Yes. And look at the difference, right? For a long call. Okay. And I put long call because that's effectively what you're trying to keep and maintain, is you're trying to nurture the long call position. So you have more credit, right? So the difference of going out all the way to May, buying the call, selling the call, doing it for 384, as opposed to chipping away, collecting the premium. You now lower it from $5 to $2.50. $2.50 for a long call is a lot different than $3.84, is it not?
Yeah.
That's a huge difference. So again, increasing profit potential, increasing the net position, and effectively just lowering the cost of the trade. Instead of just taking a trade for $5 and saying, I like BITO, I hope it goes up. Well, now you can do, the one expiration, the 517 expiration, and pay less. You pay $3.84, or you can be active every week or two, collecting some income or lowering the cost basis of that long call, and essentially taking a $27 long call for $2.50, which is like half the price. And so now your cost basis is from 27 to 29.50, and you're looking to still get it called away. Let's say we want it to get called away at $42. Well, we just increase our profit by $1.30 net, right? Or we still increase our, it's still a $15 position, but we've netted like $12 or $13 on that position instead of, $11.
Okay.
So again, this is, so up here, this is just a simple debit spread. Okay. And then this is a diagonal spread where we're using time, and we're kind of staggering the way that we trade that. So I like the diagonal spread. Okay. You could also, diagonal spreads and calendar spreads are kind of referred to as the same thing. It's just saying, I believe the stock's going to go up, but rather than committing to that stock, all at once, I'm going to try to chip away at the cost of it over time in that runway. So think about this. I have the runway right here where if I do a call option, so I determine that I want to go bullish on BITO, and I'm giving myself all this time until I decide where I could get rid of it. And that's out to the May. This is going to be our May expiration, right? So this is now, and then we have the May expiration. So I can either commit to it all up front and lower the cost basis, and this is fine, or I can take my position now and I can chip away at it, every couple of weeks and lower my cost basis and sell some calls against it. Now, in a perfect world, we're not going to get the stock called away in a perfect world. Now, what happens if we do? What happens if, BITO just surges through that 20 delta sell call? Well, we can roll that and we can get it out of the way and we go out further in time, or we can roll it and try to go up and pay a small debit for it. There's things like that. Like in a perfect world, this is perfect. In the real world, let's say that it goes way higher than we expected. You and I talked about this. There's a point in time where maybe it's not worth rolling because I don't want to pay a ton of debits to roll my calls. Although it does, give me some potential profit, I don't necessarily want to increase my cost basis. So again, ideally, and we could certainly get away with this with the deltas in the right spot, but I don't want to ever have my call that I sell, I don't want to have that threatened by the stock price. But
Well, so you would still make money, wouldn't you? If you got
oh, for sure.
called away, you still
Yeah.
have your long call option.
Yes.
But then because you're selling a call as well, you don't own anything. You don't own any shares, but you do not collect that premium.
You do.
As well?
And so there's, in this situation, if BITO goes up, if it goes up, there's virtually no way you don't make money on the trade, right? Because if over the cost of this trade, I go from 27, and let's say I lower the cost basis to 29.50. Well, right now it's trading at $30.50. So if all I did for the next, 8 to 10 weeks, Frank, is sold a 20 delta call against that long call, I could essentially have a call for free, right? Where my break even would be 29.50, and the BITO could go absolutely nowhere. And guess what? You still have, you'd have $1 of net credit right now, even though the stock hasn't moved.
Right.
So the good thing is, and this is what's challenging, and a lot of traders need to know this. If all you do is buy calls and buy puts and take a directional play, we typically have to pay so much for that premium, you don't get the directional moves that you want. And so this is, again, it's not just super simple out of the gates, but this is the more creative way to lower the cost basis. So you're not just overpaying for premium and hoping for those directional plays. Instead, we take the directional plays and then we strategically chip away the cost so we can almost have that call option for free, or try to really, really lower the cost basis where even if the asset didn't move, This would be a situation where stock could go nowhere and we could still walk away with $100 profit. Stock could go up and we could get it called away. We can still make hundreds of dollars of profit. Stock goes up, $10. We can make, $9 or $10 of net profit, right? So I'll ask this as we kind of wrap things up. I know this was just a couple of questions here, but it started out with BITO as a straddle. If that was my trade, I'd take the profit right now because there's not a lot of time left in the expiration. Then we looked at what would be a trade that I would consider doing right now on BITO. It'd be something like this. It'd be more of the diagonal trade and lower the cost basis. And look, I think BITO and Bitcoin as a whole, the instrument should pull back. So let's talk about that for a second before we wrap things up. I would love to see BITO and Bitcoin too. I mean, BITO is going up higher today. Bitcoin is it's like we're gunning for those fresh highs. But this is what I'd love to see happen on Bitcoin. I'd love to see a reality check where this thing can hit, maybe top out here with a little bit of overextended conditions and then give ourselves a pullback and find some efficiency here and then reestablish my long positions. Now, that might be wishful thinking because everyone that wanted a pullback when it went from 3 to 60 didn't really get one, right? Everyone wanted a pullback from this when we pulled back to 30 and then went back to 68 or 69, didn't really get one outside of that pullback right there. So technically, I'd love to see a pullback, but I just think you got to be patient. But going out enough time, we've seen here when the market's determined like this market ran up. This is a weekly time frame. This spent about 2 to 3 weeks pulling back, and then another 2 to 3 weeks just ripping to the upside. So if we're giving ourselves like a 70 to 90 day window on this trade, pretty confident that any type of pullback that we're positioning for, if this is a determined bull market, we're only going to get like a 1-2 week pullback, and this thing's going to start shredding to the upside again. So that's what I'm saying. Time is important where I give myself enough time to let the trade give us that direction, but have enough time where we just keep selling, in this case, selling calls against that long call to lower our cost basis. So it's just another way to trade some options. But like I said, most traders, and you're in this situation too. I mean, unfortunately, your hands are tied on what you can do. If you can't sell options, right? If you do a straddle, you can only do a long straddle. Is that correct? You can't do a short straddle.
So I have to hope for straddles and strangles. I have to hope that they move hard enough in one or another direction. Whereas, I can't strategize and hope that they stay within a range.
Yep.
Unfortunately, but
that's okay. Here's one way that last trade that I would see on your situation. So you have long straddles. That's your possibility, or long strangles. And all a strangle is 2 different strike prices. I do a lot of strangles and long strangles when it comes to options, especially when it comes to earnings and high volatility. So we could do this, and I'm just curious what it's going to cost. Let's say that we go out to, this may be expensive here, but I'm going to take a look at it. Let's go out to May and give this, actually, we don't need to go out that far. I think if we go out to like the end of March or early April, this should be fine. I'm very curious on what this thing does. I would hope we have some reality in March. It's like the stock market stretching so far, Bitcoin stretching so far. It's a little crazy out there. It's like a technical obedience would be great. So if I went out to April 5th, here's one thing I could do. And I might even consider taking this trade because I think there's no volatility on this to be pretty good. If I did like a 30 to 35 delta, that's all I'm going to look at here. But because in your case, you can only do the longs. If I buy this like 30 delta, I'm going to buy the 30 delta, which is a $36 long call. And then I would do a 27.50. Man, it is ridiculously different in these prices. These spreads are really wide on BITO. But if I did a 30 delta here, 30 delta here, okay. So we could do a long strangle, and I'll compare the difference, right? So if I did a straddle, that would be, you go out to April and we're trading at 31. So if I bought the 31 call and I bought the 30 put, you're going to pay $5.72, which means you need price to drop below 25 and change, or you need to go above 36 and change for that trade to be profitable. If you want to make it a little bit more cost effective, go out to like the 30 delta here, go to the 30 delta here, and now it's a 36 by 27. Now you do need price to go a little bit higher because again, 350 has to go beyond this. My break even for the total trade would be price has to drop. Oops, let me change the color here. Price would have to drop $3.50 below this, or rally $3.50 above this.
I don't think I would want to do that.
I don't think I'd want to do it either. Based on that cost, that's a lot of movement where you can see that we had the expected move here. If I go out see this like shaded zone that we've talked about before, it's
Yeah.
expecting the move to maybe be around $24, $24.50, but that's my break-even point for this particular trade. If it goes to the upside's saying it can't get to 39 and change based on the implied volatility right now. So I don't like that trade. Now, that being
What if you
said,
went low?
I don't love this trade either, right?
What if you went either lower or higher? Like if we're this is hard, I guess, but we say upside is limited on Bitcoin now
Mm-hmm.
for the short term by April 5th.
Okay.
Would you do a straddle pretty high in price? Like say you did $38 to $40 straddle.
So if you did a straddle, you'd want to buy the 38 and buy the 38 put. Is that what you're saying?
Yes.
Okay.
Or
Well, you're
even
going to pay a ton
35.
for that put. You're paying a ton for that put.
True.
Right?
But then 28 is now your break even if it comes lower. Is that correct?
Correct. And that's true. So I mean, if we went down here, so this is what you'd essentially be. I mean, that's number one. That's a big debit to an account, right? That's going to be a $1,000 debit to your account. Now, probability of profit, I'd say, is pretty high because if we just have a pullback on this price just needs to go down to 38 to it'd have to go to like $28. I think we can pull back. Let's look at the price here. I think we can pull back to. We could pull back to. Oh shoot, wrong. BITO. If I can type it. Oh my gosh, dude. What's a logical pullback point? That's 25. So if all you need is to pull back to 28 and it gets to 25, you can turn that position from a 10.50 debit to probably a 13.50 credit. Still make $3 net position. It's a 30% return on that position, but that's a very expensive debit to take up front. So
Okay.
I mean I'm trying to look at this situation. I wouldn't take the long strangle. I wouldn't take the long straddle because I think it's too expensive. What I would do right now is I would look at this as I'm willing to buy a call at the money. And I'm just thinking about this longer term. What's the position I would love to see this thing pull back to? If BITO pulls back to $25, I should be willing to pay longer term. And this is just me thinking out loud here. If I go into, let's see, March 8th, that's a position I already have. All right, let me go out to like the May expiration here. Right now, if $25 is a price that I think is realistic, that's an 80 delta. If I just buy the call, okay, I would do the situation I talked about before. Now, in yours, I don't know, you can't sell against this, can you?
No.
Fudge. So you can't do any spreads. So here's the good and the bad. The good thing is, $8.40 is a lot cheaper than a $10 debit. You're not really giving yourself any profit on the downside, but what you're doing is you're putting the price low enough that it absorbs any type of pullback. Because I think if we pulled back on BITO, we pull back here towards, $25, maybe this level here around $24, I'd still be looking to get long. And so what you're not going to lose on that trade is you're not losing the intrinsic value of your position. Right? That's what's kind of nice is if I did the $25 call, if we dip to $25 and then go back up to 30, I'm still maintaining that entire value of the trade. And so what does that cost me? I'm still going to have to pay a bit more of the premium for it, $8.40. So yeah, you're looking for like an extra $3 move or so. I just think it's an expensive instrument to just be long the option. So
Wait, I have an idea.
Yeah, go ahead.
This could be really dumb. But what if I shorted 100 shares, bought a call in the money? You had it deep in the money. What if you had shorted 100 shares along with having a long call?
Wouldn't that effectively just offset it? So if you shorted 100, so you're going to short 100 shares on margin and have unlimited upside risk, and you're going to take a 50, 60. I'd have to go deep in the money. If you want to do and this is what's going to happen. If you're short 100 shares, then you are negative 100 delta. So to hedge that properly, you'd have to literally buy a $14 long call, because that's 100 delta. Otherwise, you can't offset that trade. You'd have way too much risk on the upside.
Okay.
So I'd
Right,
say that's
forget that
a
idea.
no. That's a no from me.
Gotcha.
Yeah. So here's what I think. Again, if you give yourself enough time, we don't know what the stock's going to do. It's always a trade-off with options. The one that I found that I like the best would be, if you can't do a diagonal, I would just do this. I would look at the May 17th. I would look at a strangle, and I would just go slightly at like a 45 to 50 delta. So let's do like a 32, and then to the downside we could do like a 29. I mean, right here I'm noticing like 29 is a $5 call, so it's $7. I think the important thing, oh man, that's just a tough trade, dude, because long options are just, you're paying so much for that implied volatility
Well,
that
I don't know if I'm gonna look for any future ones on BITO, but
yeah,
I think just because of how limited Webull is making this right now, I
sure,
could
I understand.
just look for earnings dates and maybe even ex-dividend dates, um, and hope for that implied volatility, and don't really care where it goes, just as long as it moves out of that range.
Correct. And so here, realistically, I think the best way to summarize this entire conversation is this: I'd like to see a pullback. I think just exercising a little restraint and not forcing a position right now when it's kind of ballooned and inflated. Here's what's nice: if we come down here, that's when I would absolutely reposition for a long call and do the whole thing we just talked about in a 30 to 60, 90-day outlook,
So
and
you'd
and
have
and
a
get the dip.
long, okay, the 30, or say you do like a 90-day
Yep.
call option, long
Yep.
call,
Yep.
and then you would do maybe a weekly or monthly sell call, right?
Correct.
Okay.
I would treat it like that's what I'm doing right now on GLD. That's what I'm doing on the SPY. That's what I'm doing on. I just grabbed some shares last week on BITO, and I'm doing the same thing. I'm doing a combination of owning shares, long call, selling calls against that long call. I'm just trying to work my cost basis lower. I'm looking for this thing to have the upside that I'm expecting.
What
What's
is it at
crazy is
now?
what's that?
You're I remember you said last week you own shares in BITO
Yep. Let me
and you've
show
been
you.
selling calls
Let me go positions here. BITO. So right now my shares are up. My shares are up about, yeah. My position's up about $700 from last week when I started it.
That's
So about,
awesome.
yeah, so it's up $700 there. I mean, the day as a whole is shitty. It's really bad. But I mean, I've got some. I mean, there's enough movement going on today where it's a very rangy day. I'm just curious. Like, I think my own positions, I saw that WBA, which I have some dividend stocks in, we're trading at the low end. MO,
All true.
right? This one, I mean, I bought this around. I did like a $40 to $40.50 long calls, or sorry, I own shares, so I'm down just on the share price alone. And so I'm going to take a look at that and see, maybe it's in my best interest to get a long put to protect my shares just to be safe. Maybe go out 30 to 60 days to make sure, if in case this thing starts to, you know, it shouldn't necessarily go too much lower than this $39 level. But if it does, I need to make sure I'm protecting to the downside, because I too just can't have the exposure where this low could be hit, right? If we drop another, $2 to $3, that might not seem like a lot, but for me on 1,000 shares, that's a big drop. That's a huge chunk that I could be losing.
It's
So
weird to
I need
see Altria move this much.
it really is, and the reason I took this trade as a dividend stock is it's one of my dividend scanners for high. It's like it pays like a 90-cent dividend every quarter, so it shouldn't do much. But like I said, I think on the safe side, I want to protect myself to down to this level. So even if I did like a $39 or $38 long put, if we go any lower, I'll take that put off, lower my cost basis on everything, and then continue just to add covered calls, get my dividend every quarter, and work the cost basis down to $35, $36. If the stock goes nowhere, I can still generate about 20% return on the stock going nowhere other than monthly covered calls. That's about it. So that's why I took the trade, collect the dividend, lower the cost basis on covered calls. Net results about a 20% position. So, if I did 1,000 shares, that's 40 grand. I make about $10,000 on that trade. And
Okay.
the stock doesn't have to go anywhere. So it's a boring way to play it, but it's something I don't have to do much and think about. But I want to make sure I'm protecting my butt to the downside. That's silly. It's silly to have this thing drop, $2-3, and all of a sudden I'm caught on the wrong side of it. So
Yeah.
I'll have some protection in there. But the stuff we talked about today in this session, GLD, SPY, BITO, those are all looking pretty promising. And then I've got a bunch of out of the money credit spreads as well. Just taking a look at some of these. I'm bullish on oil, getting some bullish credit spreads in on Apple. AMD, I did a bear or a bull put spread on AMD as it rallies higher. 180, and I'm at 150 on Amazon. This is Boeing, 199, 185. So I'm just all this. Yes, it's P&L in the day. Right there's my big decline in the day. Everything else is flat, but I'm down, $1.50 on MO today, which is where most of that drawdown is coming from. But on that position, I have a $38 put that I'm collecting some premium on for a strangle, and I sold the 42, which is mostly in profit. So if I wanted to, I could close that call. It's essentially trading for nothing right now. I could close that call, take like 99% of that profit, and then just reestablish a tighter call and collect a little bit more premium out to March 28th. And so all that, boring stuff, but it's just active ways to, use options, lower the cost basis. But I do think it's in my best interest to add in a long put just in case, because the last thing I want to do is have this stock drop and let's see the floor drop out. If the floor drops below 39 and I need to protect it to 38 or 37, it's going to be in my best interest to have at least a long put there that I don't have to pay a lot for. So it's a balance, man. It's always a trade-off.
Yeah.
So anyway, fun stuff, dude. Look, I know that if this just served as like a glamorous one-on-one, I hope it helps. I'm happy to do this offline with you as well. Anyone that's listening, you want to know more about the option stuff. And I don't want to be coming in here and joining like, oh, this guy just talks about options. But I have been enamored and fascinated with ways to trade options because I make a lot more money. I make a lot more money trading options. I control my risk and portfolio where, the money I manage is way tighter risk, defined risk, and just having your risk adjusted returns. I feel like I can keep my drawdown single digits and produce double digits on the upside. And there's not a lot of instruments you can trade that can do that. So I think options are pretty fantastic.
Yeah.
So I think Frank
Well,
likes them.
yeah.
He enjoys these
I
sessions.
I enjoy learning about these, and
Yeah.
you're right. You can make a lot more money, and you can reduce the risk, as in not just as in how much you lose, but the probability of things going against you. Like you can still walk away with money in different scenarios instead of either going up or down, win or lose. So you'd have like 3 ways to win, 1 way to lose, something like that. That's why I'm trying to learn, and
This
who
is
better
the
to learn
crazy.
from,
This is the crazy stuff right here. So right here on the typical like profitability curve, most of the standard deviations in stocks, you have about a 68% chance that you're going to be correct within that one standard deviation move. So if this is the actual stock price right in the middle, 68% of the time, the market's going to stay within that implied volatility. And the way that they calculate that is oftentimes they overstate it. So this probably is more like 72 to 75% probability. That is why, this is where option traders make their money. It's like they trade probabilities and there's a fair trade-off in efficiency all the time. You get out this way, you're talking like 90% probability that the market can't go. Actually, I take that back. This is like the 75% out here, and then 90+% out here. So like it's like 92%. So all I'm showing you is based on probabilities, this is where we can survive in options and make a decent amount of money. If this is the actual stock price, if I survive in the 68% window, obviously you're not going to win every trade. If I go out to the 75% window, I'm going to win a lot of my trades. I'm going to sacrifice a bit more of the premiums and the profits as far as like I'll get, maybe 20 cents on the dollar, but my probability is really, really high. If I go out to the 90 cents, 90%, that's like way out of the money. Probability of winning is extremely, extremely high. The issue with that is you're collecting like 5 cents on the dollar, 10 cents on the dollar, but you can still live in that environment where it's like, yeah, I just win like 90+% of my trades and just safely collect income, And so I get really creative in this window here. And then if I'm out of the money, I just have a general like collecting income mentality, then I'm out here. Right. So I try to, I mean, that's what options is to me. It's all probabilities and you try to manage your risk. But what's nice about it is so many trades you take, it's defined. This is what I can make with this probability. This is what I would lose. And you know it upfront. And,
Yeah.
yes, you have a stop loss and other instruments as well. But, stocks can go up, down, sideways, up a lot, down a lot, nowhere. So 4 out of 5 ways you can make money selling options. One way you can make money buying options. You got to be right on direction. You got to be right in time. You got to cover the cost of the option, which is why we looked at those examples today. If I bought that option, it'd be nice to also sell something against it to chip away at the cost. That's what's going to give you the edge on some type of long option is lowering the cost of that so you can end up making more money in the long run and do it with a high probability.
I
So
definitely
good
need
stuff.
to figure out a way to sell options for sure.
Yep, for sure.
yeah.
And I hope you can. I'm gonna get it. I think I did this real quick, Frank, while we're in session today, and then I've got to switch gears and jump into my trading room. I know a lot of people are watching, but let me see this. So GLD right here. I just did. So I've got the fudge. I might end up rolling this. This is an iron condor that I did. I might end up rolling that. So I've got the bull put spread, the 186 by 185. Let's see here. I've got an iron con. Okay, so I need to establish that position. Okay, so this needs to be rolled or take the loss on, and then I've got a 190 call that I'm going to start selling against it. So I did the exact same thing we talked about on BITO on GLD today, and I'm going to talk about that in my trading room in the next little bit. So I went in and did a 190. So it's a 517. Oh, sorry, it's an April 19th actually. Nope, I'm right. 517 expiration. 190 long call. Now against that, I'm probably going to go out to like 315 or 328, and I'm going to sell a call against that, and I'm just going to chip away because it cost me 795 for the debit. Okay, 795 debit. My goal is to go out over the next 70 something days and lower this by hopefully $1 or more. If I could lower this by like 25%. I'm going to try to do that and try to be right in this breakout in gold.
So you're going to sell calls on like a weekly basis?
I'm going to try to. I don't know if I can get the greatest premium for that on the weekly basis, but I'm going to try. So if I go out to GLD trade, I go out to the 15th. That's 2 weeks out. I could sell, but this isn't bad. I could do GLD's trading at 195. I could do like the 200. That's a 26 delta. I could sell that. I mean, that'd still give me so I paid $795 for a 190 call. If I lower my cost basis by $1, now I paid $695. I could still walk away with $2.05 of profit. If I don't want to get it called away, then I lower it down here to a 17 delta, lower it by 60 cents, and again and again and again, and just keep doing that. I don't mind that. If I do a 200, collect almost $1 for it, and I did that every couple of weeks, I think that'd be pretty awesome. So I'm not looking at it like I'm not trying to hit a home run on GLD. If gold is going to go higher and GLD is going to go higher to correlate with it, if I turned an $8 debit into a $3-4 win, and I make 50% on my position, that's still that's a good trade to me. So yeah. So how about this? Let's talk about it more this week. I'm going to run and get into the trading room. I know it's been long and everyone watching, sorry for the delay, but I got to run to my equities on demand trading room. But gold is crazy. It's going to be an interesting month. I'm not just going to put everything on this week. I do expect there to be a pause or a pullback coming. I mean, Nick talked about it. You talked about it. Stagflation stuff, I think is going to be an interesting narrative in the next few weeks if it becomes a real thing. But I keep going back to this. 16 of 18 weeks bullish. Come on, man. This market's broken if we keep going higher. If we stretch to 18 out of 20, that's just absolutely insane to me. But, market stays rational longer you can remain solvent, as they say, right?
Yeah, I think I've seen many times where we reach that broken spot and then we're like, well, what do we do now? And then it finally corrects. So
yep.
Maybe
so
that's where it's gotta go.
And here's what I think happens too. It's like, bottoms form a lot more violently than tops do typically. So I could see the top just kind of drifting, and then the bottom falls out of that top. So I wouldn't be surprised to see something like this where the market goes up. And it just, we're already up high enough, but we just kind of stay here. indecision, maybe melt just a smidge higher, and all of a sudden, like, that floor just gets busted to the downside. And that's where I see there's enough news stacked up in the coming weeks. Non-farm Friday, CPI, PPI, and the March rate decision for the Fed. That combination of events could be enough to drive this thing 3, 4, 5% lower, just to have a necessary technical correction. Even if the market buys the dip immediately, I just think that we have to have some type of like nasty aggressive pullback like we did there, right? I mean, it tried, but it didn't follow through. So I can see the same type of thing where there's buyers just eagerly waiting, but it's tough to justify buying at these crazy highs.
Yeah.
So
Agreed.
that's my thoughts.
But yeah, thanks, Chris. I gotta go too. I have to finish a lot
Okay.
of stuff.
Well, I'm glad your battery lasted this long.
Yeah.
Appreciate it.
It's charging this time because I knew Mondays
Perfect.
with you is gonna be a long learning session that I gotta be ready for.
Yeah,
But
good stuff.
but thank you again, and yeah, hopefully we can hop on some more calls and do this every week too.
Sounds good. All right. Thanks, Frank. Thanks, everybody.
Thank you.
Thanks for watching. See ya.
Bye.
Thanks again for watching today's show. Our goal at A1 Trading is to continue to share free value to our audience through daily videos and articles, keeping you up to date with the latest market coverage. If you enjoy our content, make sure to subscribe for more. From all of us at A1 Trading, have a great day, and we'll see you next time.